Hey, welcome back to the second part of the chart patterns. We are going to continue onwards and talk about triangles as well as wedges. These are also important patterns that many traders look into. So without further ado, let's get into it. First, let's talk about the ascending triangle. Ascending triangle is a popular chart pattern and it is represented by a support trend line that's going up and it converges with a horizontal resistance. So what does this chart show? Right? With the ascending support line, this means that there is more and more demand over time. We can see that the buyer is pushing the price up. It does fluctuate back down and hit a low. However, this time it is actually a higher low and the buyer pushes the price back up again. It does hit a resistance consistently. However, as we can see from the support point of view, the price is slowly going back up. So buyers are being aggressive in this case, right? They're becoming more and more aggressive. They're getting stronger and stronger. There's more and more demand. Whereas the sellers are only strong at this resistance point. Eventually, both of these trend lines will meet, meaning that the price will get squeezed into an end. And when this occurs, it means that the price will have to break either up or down, right? So how do we use this to an advantage? Well, first of all, in this case, it is more likely that the buyer will win. The buyer will win, meaning that the demand will go up and the price will likely to break up. Why is this? Well, because they have been slowly pushing the support back up, right? Even though there are sellers that's strong at this point, they are slowly being pressured by the buyers. The buyers are slowly pushing the price to them, and because of this, it is likely that the buyer eventually will win out. So how do you profit from an ascending triangle? Do you just buy at the end of the wedge over here and wait for it to break up? Well, no, you don't do that because there's still a possibility for it to break back down, right? When we are talking about opportunities for trading, entry points, we always have to assess the probability, right, of winning. When you're at this point, even though yes, there's a higher chance for it to go back up, is not for sure, right? It's never for sure. But in this case, if it breaks up, if it actually breaks this resistance, then it is way more likely that it'll continue to go back up. Because in this case, all the sellers will either hit their stop loss or they will realize, okay, they're gonna lose. So the people that are shorting the stocks, they will buy back their stocks, pushing the price even further up. So in this case, people will ride the wave. Most likely, majority of the smart people will ride the wave, and that will push the price even further. So what you want to do is you actually want to put an order above this resistance and wait for the wave to occur so you can ride the wave up further as well. You don't want to buy it at the wedge because there's less likelihood for it to break up than until it breaks up, right? So you can also, in this case, put a stop loss, right? Once it breaks up, you can still put a stop loss, maybe just around the support or slightly below the support. And in this case, if the price actually reverses, you won't lose that much. However, there's a higher amount of money that you can win when it breaks up as well. So that's how you manage your risk. So let's say when you hit your stop loss and you lose, say 10 cents. But when you take the profit, you probably can take 20 cents of profit. Then that's when you know you have a good risk management and good probability. Cool. Let's talk about the next one, which is descending triangle. Again, it is the opposite of ascending triangle. So in this case, the seller has a momentum pushing the price downwards, and the resistance slowly converging with the support for the resistance to actually keep going down. So in this case, sellers are more aggressive, they are winning slowly, so it is more likely for the price to break further low. In trading, we always talked about how important it is to be patient. So by going flat, you are making profit as well. So what I mean here is that if the pattern does not look good, and maybe you don't want to just look at the pattern, you probably have to look at other things. Like we talked about trends already, we talked about the structures, we talked about the doji patterns. If some of these don't line up and you feel like it doesn't look right, then don't buy it, don't enter, or don't sell. In this case, look for something else, and more importantly, don't come back and doubt yourself thinking that, oh, I could have done this, I should have done this, right? Stick to your system and be persistent with it. Okay. Lastly, let's talk about a wedge. So a wedge is another triangle that we're gonna be looking into, but in this case, it is neither ascending or descending because it forms a lower high and a higher low. So essentially they're converging somewhere in the middle. So in this case, many people will watch this pattern, right? And you may ask, okay, so is it gonna go up? Is it gonna go down? What's Austin gonna tell me, right? Well, I don't know. Nobody really knows. So in this case, it's gonna go up and it's gonna go down. It could be either or. So we just have to be patient and wait for it to break in one direction. But I can tell you, because everyone is looking at this and everyone's waiting for it to break to one direction, the moment it breaks to that direction, everyone will ride that wave. It means that it'll push the price even higher if the price breaks above, and it's gonna push the price lower if it breaks below. So all you have to do is put an order above the resistance if you want to purchase a stock, or maybe put the order below the support if you want to short a stock, and just ride the wave when it happens, right? You can even do both, and the moment that it hits one of your order, you cancel the other. Whatever it is, you have to be patient and wait for it to break up, and that's the best way to do it. So there are many other variations, right, for a wedge. It could be a wedge up, it could be a wedge down. What a wedge up is, pretty much it looks similar to ascending triangle, except the resistance is also in a tilting angle going up, right? So it looks like a triangle that's just completely pointing upwards. So because there's so many of these, right, again, you don't want to memorize the name and maybe not even just the shape. You want to understand what it really means. So when you're looking at ascending triangle, you know that the buyers are slowly winning, so it's likely the price will go up. For wedge up, the resistance is also slightly going up. Again, that just means that buyers are winning even more. So again, it probably means that the price are likely to break up further. So what I'm trying to say is that instead of memorizing the names and memorizing the shapes and trying to fit the shapes to your charts that you see, understand it. And that way it is more likely for you to actually win more, right? And at the end, I want to emphasize again on reducing the number of variables in your analysis. Don't worry too much about understanding all the chart patterns, right? I only talked about less than 10, right? And if you categorize them, probably only 6. We talked about head and shoulders. We talked about the double top, multi-top, which can be just combined. We talked about double bottom and multi-bottom. And those two are very similar, right? We talked about the triangles. So honestly, that's probably enough. There may be a few more that might be commonly seen, but I don't want to overload you with information. If you have too many variables, right, in statistics, that's called overfitting. Sure, you can probably perfectly predict what has happened, right? If you put your many variables into the chart, you might be able to predict what has happened in a data set that doesn't have enough data, right? But overfitting is an error itself. It means that you're not gonna predict anything in the future. So more variables does not mean more precision. By actually reducing your variables and being able to predict majority of the past trends, that's when you know you have a good system. There's never going to be 100%, so aim for, I don't know, something that's a decent percentage that you're comfortable with, right? So I hope this series has helped you so far, and I hope you have liked the chart patterns. We're going to talk more about technical analysis. We're not done yet. We're going to talk about a few more indicators, and they'll be very interesting as well. If you enjoyed this series or if you enjoyed this video, please like and subscribe. It would help my channel tremendously. Thank you so much. Until next time.